As a market, crude is one of our most popular commodities. Certainly, it certainly takes a lead in terms of client interest, mainly because so many people understand it or know they see it every day, regularly reported in the news. And really, I think crude oil is something you feel you can have an opinion on very easily. It's clearly tied to the health of the global economy. We know if the price of oil goes up, what does that mean for the US economy? What does it mean for, and the price at the pumps as well. So as consumers, we obviously have a vested interest in the price of crude oil, and so it naturally feeds through into client interest. It runs from about 1 AM in the morning till 11 PM at night for UK clients. So it's not quite 24-hour, but overall it does actually trade almost 24-hour. Well, it's traded in dollars per barrel, and now that it's the same barrel size both for crude oil and for Brent, so there's no sort of different sizes in barrel, but it's dollars per barrel, so it's a clear unit that everyone can understand and appreciate. I'm not quite sure the size of a barrel, but generally it's a clear size that everyone understands and can then use as a benchmark from there to gauge the importance of crude oil in terms of the global economy. As you're trading physical commodities, you wouldn't expect anyone to turn up with crude oil barrels on your doorstep if indeed you were to trade them. With futures, of course, you would need to specify that you roll over the contract, but we don't have that worry at all with spread betting because clearly it's a derivative of the actual futures contract in crude oil, so there's no need to worry about the physical oil arriving on your doorstep. Well, I think, like anything, crude oil is motivated by buyers and sellers clearly, but it's how that plays out in the global environment. And with so many different factors with crude oil, obviously economic data is one of the key areas. So US non-farm payrolls, PMI data, and Chinese economic data as well. So it's just sort of a proxy for the health of the global economy. But also we're dealing with US crude inventories that come through on a weekly basis. So on a Wednesday, you get the American Petroleum Institute report, and then the US government releases its official figures on crude stocks. So that's also a second way of gauging how the global economy is playing out, because clearly if US stocks are being run down, that generally means that the US economy is doing better. Clearly if stocks then go up, it means the inventory is more widely available, more crude available. Like any market, if more of a commodity is available, the price tends to go down. But really crude, its approach is determined by how people view the global economy. Is it going to improve or is it going to get worse? Now, we saw that in a substantial way in the 2008-2009 when the global crisis hit and growth expectations were reined back massively, and we saw crude oil slump dramatically in price. And although it's come back a bit from then, it hasn't reached the highs that we talked about 2008 really. Well, we know that the long-standing tensions in the Gulf between the US and Iran over their nuclear program do worry oil traders, but we haven't seen a sustained rise in the price of oil that you might have expected. And partially, although there are rumours and reports that the Iranians are holding exercises around the Straits of Hormuz and that the US are also deploying warships to the region, I think most market investors have realised that because Iran is such a major oil producer, so much of their oil flows through the Straits of Hormuz near Saudi Arabia. So if they were to close those, it would be essentially cutting off their nose to spite their face. So although it would be a natural response to the Iranians, I think, against US sanctions to actually try and do some real damage to the global economy by cutting off that key oil area, and I think it's around 30% of all global oil that's transported around the world goes through that very narrow sea. But although it's an obvious thing for the Iranians to try and do, I think it would then hurt them so directly that that's why they've avoided doing it. And that's why the actual impact of US sanctions and the tensions in Iran have really failed to have too much of an impact on the oil price. It can be on those days, with the Wednesdays and Thursdays when you have official US data come through, there can be certainly quite a degree of movement in the price of oil there. There are also times to watch out for non-farm payrolls day, because then we see the direct health of the US economy in terms of job creation. And so you can see oil move quite significantly on non-farm payrolls day. In our webinar that we run at IG over that, we often trade oil using the demo platform, and it's either our biggest winner or our biggest loser, because oil is such a useful proxy for the health of the US economy and the global economy that when such important data comes out, oil naturally becomes very volatile on those days. But other days, of course, like anything, you can have a quiet day where nothing very much moves in crude oil. Well, there are a number of them listed in the UK that investors are probably quite familiar with, BP being the most obvious one. that one there that clearly has really failed to recover from the oil spill in the Gulf of Mexico in 2010. Litigation goes on there. Others to watch out for: Tullow Oil, company with major exploration interests now off the coast of West Africa and also in East Asia, so there's clear areas. BG Group is another one now exploring off Greenland. It did very well actually in India in oil exploration and then sold off that to Vedanta Resources, so there's another one that is a company that also mines for commodities as well as oil. And then if you look also just away from the actual oil companies themselves, there are those connected to the sector. So you've got Socco International, Lamprell, Hunting, that provide facilities for oil companies. So they provide the pipelines, the engineering that goes with that. So there are a number of ways, I think, to play the oil price, to sort of indirectly to move investors away from just looking at the price of crude oil itself in terms of dollars per barrel.